Hi, thank you for joining us for Newcastle Discover, Approaching Retirement, our February event. I'm Lucy Pritchard, I'm the Alumni Relations Manager. First of all, I just want to share that this is an independent webinar, so it's not linked in any way to the university's formal pension communications and recent educational and update sessions that have been held for university staff. So this is very much an independent seminar for our alumni community. I would also like to say a huge thank you to our alumna and Alumni Achievement Award winner, Maria Nazarova-Doyle, for letting us organise this event and offering her colleagues at Scottish Widows services. So thank you very much. Now I'd like to introduce our speaker today, Martyn Allan. So Martyn has been working in the financial industry with Lloyds Banking Group for 12 years, and for the last 3 years, he has worked with Scottish Widows presenting on workplace pensions to help customers understand more about their future savings. Now, Martyn has a passion for presenting and ensuring that everyone can take charge of their finances. And having seen Martyn present yesterday, I really understand his passion and his ability to make very complicated things easy for me to understand, and hopefully everyone else too as well. So Martyn, I would like to pass over to you for your presentation.
Excellent. Thank you very much for a very lovely introduction, Lucy. Just in a moment, you should hopefully be able to see my presentation being shared. So just give me a moment to bring that up. But yeah, I'm part of the workplace presentation team here at Scottish Widows. So what we do basically is we talk to clients, we talk to customers, we talk to individuals about pensions, about understanding more in terms of how you can save, how you can access your money, and really just whatever that means. So today's session is all about planning for retirement, approaching retirement, and we're going to be talking about a few different topics. We're of course going to have time to answer some questions, of course, as Lucy's mentioned as well. I'll try my hardest to get through as many as possible today. When it comes to answering questions, I won't be able to provide any financial advice for you, but I will give you, essentially, it doesn't stop me from answering your question. I might not point you towards a particular solution. I might talk about getting financial advice independently. However, I will try and answer your question to the best of my ability. For now, though, the session will probably run on for about 35 minutes or so in terms of the presentation, and that should leave us plenty of time for questions. In terms of what we're going to cover today, we're going to start off with, well, why are we planning for retirement? What does it all mean? Why are we essentially preparing for retirement when we're not working? We'll talk a little bit about the state pension. We'll then move on to talk about how you can manage any pension plan that you have today. We'll talk about how you can access your pension at retirement and the different ways that you can access your money. We'll talk briefly about investments, and we'll finish up with just a bit of information about things that you might want to think about in terms of a plan of action as you're approaching retirement. Now, although I'm from Scottish Widows today, there's a good chance that you don't have a pension with Scottish Widows. You might have a pension with any provider, and that's absolutely fine. I'm not here today to tell you about how you can access your pension online with Scottish Widows or indeed sell you any of our products at all. It's simply for information purposes only. So without any further ado, let's get started and let's think about why plan for retirement. Well, it's a big question, sometimes a loaded question as well. But essentially, when we think about why are we planning for retirement, it's a good time to step back for a minute and think, well, what kind of retirement do I want? When I eventually stop working, when I stop needing to work or wanting to work, I guess, what do I want to do with all that time that I'm going to have? Now, we've asked this question, as you can imagine, a great number of times, and typically we get quite similar answers. For example, learn new skills or take up new hobbies. Maybe you just want to spend more time doing the hobbies that you already really enjoy. Maybe you want to travel, live abroad even, if that's something that interests you. Maybe you just want to spend more time with your friends and family, enjoying that free time as you normally would. These are all the things, the lifestyle things that we look forward to when it comes to retirement. So really the things that inspire us to save more. And then we have to think about something a bit more serious, unfortunately, and that's financial security. Now, financial security is all about being able to afford what you need to pay for, and of course, having the security to spend money on yourself and enjoy that free time. I did mention that we're going to talk about state pension, and we will do in just a few moments, but we would ideally like to have less reliance on the state pension, and that's why we save into a personal or a workplace pension ourselves. Now, in terms of financial security, I've just brought up a whole list of things that will probably make people unhappy a little bit, so my apologies. But essentially, what does your salary pay for today? There's a whole list of things here that we do unfortunately have to shell out for. So whether it's a mortgage or rent, whether it's holidays if you're lucky enough to go out on holiday every now and then, probably not so much in recent times, of course. Things like insurance policies, council tax, optical care and dental care. These are all the things that we need to consider paying for just now. But when it comes to retirement, when it comes to financial security in retirement, which of these bills might we be allowed to get rid of? Well, actually, if we think about it, hopefully by the time we reach retirement, if we are currently paying a mortgage, hopefully we'll have had the chance to pay that off. That'd be a huge saving in terms of what you spend in retirement. But actually, almost everything else might still exist. In fact, you might spend more money on things like holidays. You might spend more money on hobbies, dental care, optical care. Of course, if you do have children, you'll know that the bank of mum and dad probably never closes. I speak as a customer rather than as a mum or dad myself. However, all these things still need to be considered when we think about retirement and our affordability in terms of our income. Now, in terms of how long retirement could be, this is a really important topic that actually not many people think about. Typically, or on average in the UK, most people tend to retire around about the age of 65. However, life expectancy in the UK is changing. Over the last few years, studies have been carried out to find that males and females who retired at the age of 65 in the last 5 or 6 years had a life expectancy of around about 85 years. Slightly less for a man, slightly more for a woman, but we'll not go into that in too much detail. However, on the right-hand side of this screen, hopefully you'll be able to see a different kind of statistic altogether. 1 in 3 babies born in 2016 are believed to live to be beyond 100 plus. Now that is potentially a scary figure. And for anyone who's approaching retirement just now, our life expectancy is going to be somewhere in between these two figures. So retirement might be 10 years, it might be 15, 20, 35 years potentially in retirement, depending on when you retire and of course your lifestyle itself. So although we're planning for saving as much as possible for retirement, it's also good to understand that we'll need to budget and plan through retirement to make sure our money lasts as long as possible. Fortunately, we might get some support when it comes to retirement. If you're a UK resident or if you have been a UK resident, there's a good chance that you've started to build up some state pension. Now, I will talk about some rules. As you can imagine, it's a government kind of income. There are rules associated with that. However, for this current tax year, 2021 to 22, the state pension figure is £179.60 per week, which is just over £9,300 of support from the government per year. Not everyone's going to be entitled to that full amount. Again, I'll talk about that in just a moment. Each tax year, this figure tends to change. For example, next year we expect state pension to be around about £185 each week. Now that tends to change with inflation. And of course, as inflation increases, this should increase alongside that. It's all about cost of living. Now, the state pension is not designed to help us go on cruises or holidays or buy expensive cars and luxury items. It's designed to help us just get by and pay for the very basics. What we want to do with retirement, the things that we want to spend our money on, that's why we save independently. In terms of state pension, I did mention there are some rules. Firstly, when can you access that money? Well, actually, you can begin to access that money as early as age 66. However, the age you can access that money is different depending on when you were born. Because average life expectancy is on the rise, when we can access this money is also on the rise. At the moment, the oldest you'll have to be to claim that is 68 years old. Now, in terms of how much state pension you can receive, these are where the main rules come into play. So in order to receive any state pension at all, you'll need to have accrued at least 10 years of qualifying national insurance payments on your record. So working, paying national insurance payments in the UK for a minimum of 10 years. That will allow you to have a pro-rated amount of state pension, so you will get a level of support, just not the full amount. That pro-rated amount will keep increasing for every additional year that you have, up to the full 35 years of national insurance contributions. Even if you have more than 35 years, that's going to be capped at the maximum state pension amount. So, if you're considering your position, if you want to know what your state pension might look like, no matter what age or stage you're currently at, you can get your state pension forecast at gov.uk/check state pension or yourpension.gov.uk. You'll be asked to provide a little bit of information about yourself, including your national insurance number, but then you'll be given a forecast as to what you can expect and what that'll mean to you in retirement. For now, though, let's move on and think about how we're managing our current plan today. So as I mentioned earlier, you might have a plan or a pension policy with different providers. You might just have the one pension plan. It might be a personal pension, a workplace pension, or even what's known as a final salary or defined benefit pension. There are lots of different kinds of pensions, but typically your provider will have online services or information available to you to understand more about your policy. For example, if you log on to your provider's website, this should help you to understand your pension, show you more information in regards to things like investments, provide some tools and calculators to help you make plans for the future, as well as if you're considering making any changes, for example, to what you pay into your pension plan. As well as that, you'll often find contact information and frequently asked questions to help you understand as much as possible and to answer any questions that you might have as well. Now, depending on which provider you're with, you should also be able to access your pension fully online in terms of, my apologies, we're going the wrong way here. You should be able to access your pension fully online in terms of managing your policy. And what I mean by that is being able to log into an online service which is secure, and have the facility to check on your pension at any time and make changes should you wish to. Often you can see this as an app that you can download for smartphones or tablets, or you should just be able to log in through a website as well. Failing that, or if you prefer to, normally you can always contact your provider by phone or email, or indeed you can write to them at any time. Now, one of the things that we get asked quite often about when we talk about pensions is, well, actually, I might have more than one pension. Over most people's or the average career in the UK, we tend to see people having around about 11 different jobs in their lifetime. Now, if you have different jobs with different employers, there's a good chance that you're going to have more than one pension currently open. The most important thing to think about if you do have multiple pensions is keeping up to date with all individual pensions. Make sure you understand who the provider is, how much you have in the policy, and really keep an eye on how that's growing and making sure it's working as hard for you as you want it to. However, if you have multiple pensions, but you'd prefer to have all your money in one place, that is, of course, absolutely fine. With most personal or workplace pensions, you can essentially combine your policies together with one provider, typically the one that you currently pay into. That might make things easier in terms of managing your policies, in terms of keeping an eye on all your retirement income. If you want to complete other pension transfers, you can normally do this using your provider's online facility or by getting in touch. They'll often provide education and guidance to understand if the transfer is right for you. Normally, they will not provide any financial advice. This is what's known as a non-advised transfer, meaning that it's completely up to yourself if you want to do so. However, that education and advice will help you to understand things that you might need to consider. Typically, you'll be able to submit an online application, which doesn't take very long at all, and your provider will take it from there, getting in touch with any other pension policyholder that they need to. You'll always be kept up to date and you'll receive confirmation once your transfer is complete. So if you do have multiple pension policies and you're sick of getting letters from different companies and trying to understand where all your pensions are, it's easy to combine them if you want to. The one thing I would say about combining pensions is for anyone who's lucky enough to have a final salary, also known as a defined benefit pension, These are transferred in a different way, and you would need to speak to an independent financial advisor in order to do that. That will come with a fee. So anyone who does have a final salary pension, if you do want to ask any questions about how that's done, please do let me know. When it comes to retirement, when it comes to managing your policies, your accounts, your retirement income today, we might have to think about some other sources of income. Do you have anything else in the background that you could use in retirement to help sustain a lifestyle or to help give you the lifestyle that you want? You might have things like pension or bonds, inheritance, other stocks and shares that you invest into, premium bonds, pensions or other personal pensions. You might be using ISA accounts and making the most of your ISA allowance, any personal savings that you have, and any money from property that you want to use as well. When it comes to managing our retirement income, we don't have to wait till retirement to do that. You can start to think about the other sources of income right now and how that might impact your retirement. Now, we're going to move on to retirement options, and this is essentially a bit of a rundown of how you can actually access your money when it's tied up in a pension. Now, I'm going to go through the options with you, but essentially back in 2015, the government came up with something called pension freedoms. This gave us a little bit more choice in terms of how we can access our money, and I'll take you through these options in just a moment. Before we get there, there are two main headlines to talk about. Firstly, when can you access that money? Well, actually, with a workplace or personal pension, you can typically access this pension as early retirement age. Now, currently, early retirement age is 55 years old. However, that's going to move to the age of 57 by the year 2028. That will be the earliest you can access your money. The other headline to mention is all about tax. Now, typically when you hear that word, you're probably thinking negative things. However, we actually get tax relief when we pay into our pension plan, if it's a workplace pension. But when it comes to withdrawing money from your pension, you'll also be able to take up to 25% of your entire plan tax-free. You can take that as a lump sum if you'd wish, or you can take that in smaller portions as you go throughout retirement. Now, typically, if you're thinking about taking your 25% as a lump sum, you may want to access that to help pay off the final part of a mortgage, to hold in your own savings, to use to spend how you like, maybe on holidays, maybe on some things that you've been looking forward to buying. But remember, that's reducing your overall retirement income. Now, the options themselves are essentially varied in different ways, but you can mix and match the options. So no matter which provider you have, you can move different providers to take different options and find the ones that make most sense to you. We're going to start off with flexible drawdown. Now, with flexible drawdown, as I've mentioned, you can take up to 25% of your pension tax-free. Whatever money you don't take straight away will remain invested with your provider. They'll continue to try and grow the value of your money through investments, but in the meantime, you can access that money whenever you like. You can dip in anytime you want or need any money, and you can take as much or as little from your pension as you like. It's completely up to you how you manage that pension, so how long is that going to last you in retirement? And it's always best to maybe have a plan of how much you'd like to spend each year to make sure your pension lasts as long as possible. Remember, it's still invested, so there's a good chance it will still grow, even though you're in the process of withdrawing that money. However, if you do manage to take too much money too soon, you can leave yourself short later down the line. Next up, we have a product known as an annuity. As you can see here, it mentions that's a guaranteed income for life. Now, an annuity is a product that's been around for an awfully long time. Essentially, it's a contract that you'll take out with a pension or insurance provider. Again, it doesn't have to be your current pension provider. You'll be asked if you want to shop around to make sure you get the deal that's best for you. But essentially, using some calculations, so including how much money do you have in your pension pot, what age are you retiring, how long are you likely to live based on average life expectancy and lifestyle, etc., as well as a few other factors, your new or your current pension provider will offer you a contract which will pay you a guaranteed sum of money each month or each year, depending on how you want to take that. And that money will last you literally until the day you die, no matter when that is. So if you lived, for example, for 10 years in retirement, your money would last for 10 years. Anything that you hadn't taken that you had saved would technically belong to your pension or insurance provider. If, however, you lived a lot longer than was expected in retirement, perhaps 30 or even 40 years, you're still guaranteed that money no matter what, to the deficit of the insurance or pension provider that you're with. So actually, this is something for you to consider if you're thinking about having a guaranteed income. Next up, we have the ability to take your entire pension as cash. It's quite simple when you look at it. It is essentially just moving all your money from your pension provider into your own bank account. As you can imagine, I did mention we talked about taking 25% of your pension tax-free. That does mean that no matter what option you take, the other 75% of your pension is subject to pay as you earn tax. So depending on how much money you take at any given time, over the course of a year, you'll be entitled to pay tax on some of that money. When it comes to taking your entire pension as cash, you're taking all the money at once. So the taxable portion of your pension will need to be paid upfront. Once you've paid that tax bill, though, the rest of the money arrives with you in your bank account, and it's completely up to you how you use or spend that going forward. You don't have to just select one of the options I've talked about. You can mix and match the options to suit your lifestyle and suit your needs. And of course, typically your provider or even things like the money advice service or PensionWise can help you understand more about the options that are available. The last thing for me to mention on this slide is the ability to defer your pension. Now, I did mention earlier that most people tend to retire on average around about 65 years old. Even when your provider writes to you to talk to you about the pension options that are available, you don't have to retire. You don't have to access that pension at that given time. You're allowed to continue to defer or save into your pension for as long as you like until you're ready to take that money, and simply let your provider know at that time when you're ready. Now, this goes a little bit more into detail in terms of the options that I've talked about, but I think the best thing to kind of mention here, I've covered almost everything there, but the best thing to mention here is that when it does come to taking your pension options, the best thing to do is have a conversation with your pension provider, but also really try to understand how you want to access your money. Would you rather have flexible access? Would you rather have something that's guaranteed? Or actually, do you want both? Now, one thing that we have to think about, unfortunately, it's something rather morbid, but one thing that we have to think about when it comes to pensions is actually we're saving up quite a lot of money for retirement. What happens to that money when we die? Now, it's not nice to think about, but it is something that is incredibly important. Now, using your own provider's online system or by getting in touch, you can complete what's known as a nomination of beneficiaries form, and you can do that right now for any and all pensions that you have. It's best to do it now if you haven't done so already. Essentially, however, a nomination of beneficiaries form is your way of telling your provider who should be in line to receive the money that you would leave behind when you die. So whilst you're still saving up for your pension, that's incredibly important, of course. But even when you take your pension, if you take flexible access to your pension, then it's best to complete one of these forms again to make sure that any money you've not spent already, of course, goes to your loved ones. Now, normally you can nominate absolutely anyone you like. It doesn't have to be immediate family. It could be friends or even colleagues or co-workers, of course, if you like. You can also nominate multiple people. Now, you can change or update that form at any time. So if your circumstances change, if you get married or get divorced, if you have kids or grandkids, or if you just decide you don't like somebody anymore, that's absolutely fine. We don't need to know the reasons. All you need to do is make sure that you update that form so it suits your circumstances at any given time. The process for leaving money behind to loved ones is incredibly quick. It's incredibly simple, and there are no fees or charges at all from your pension provider. Now, instead of your loved ones paying inheritance tax at 40%, if you die over the age of 75, whoever accesses the money that you've left behind will pay tax on that money at their normal rate. If you die under the age of 75, whoever accesses the money typically won't pay any tax at all. So it can be incredibly beneficial for your loved ones. And if you've not completed a nomination of beneficiaries form already, please do think about doing that as soon as possible. I'm going to talk just very briefly about pension investments, and particularly what happens to your investments as you begin to approach retirement. Before we go into too much detail though, just to give you a quick few headlines on how investments work, just for those who haven't really looked into investments before. Typically though, investments, whether it's a pension investment or an individual investment, it's all about risk versus reward. When we talk about reward, what we mean is the ability for your money to grow in value. And when we talk about risk, it's the ability that your money may actually decrease in value at different times. Now that sounds negative straight away. However, let me explain that pensions are an incredibly long-term investment. And the longer the term of the investment, typically, the better results you tend to see. When you're further away from retirement or further away from the end of your product, it's easier to think about taking a higher level of risk and aiming for as much reward as possible. However, as we start to approach retirement, we might start thinking about securing the investment risk that we have, taking less risk, and of course earning less reward, but feeling more secure with the money that we are investing. Now, most, if not all, pension providers will invest in different sectors of the market, whether that's low risk investments such as cash, medium risk investments such as bonds and property, or your higher risk investments, which are stocks and shares. Now, if anyone's seen the news talking about the FTSE 100 or different shares or different markets, typically they're talking about equities, which are stocks and shares. Now, that's your higher level of risk, but that tends to be where most of the growth is. So when you're further away from retirement, typically you'll be invested into more equities, your stocks and shares. However, with most pension providers, as you begin to approach retirement, they'll introduce what's known as a lifestyle plan. That typically means that the value or the risk, of your investment will reduce over those few years before retirement. So you don't have to worry about taking less risk yourself. It's managed for you in the background by your pension provider. In fact, if you stick with your pension provider's default investment strategy, not only will they manage that lifestyle for you, but they'll also be in the background all the time, making sure that they're making positive changes and keeping on top of the risk that's involved in your pension to try and get you the best possible reward for the investments you're making. Now, when it comes to making investment choices, as mentioned, you can stick with the default investment that's offered by your pension provider. However, again, all pension providers should offer you a choice to self-select. As you could probably tell by the title, self-select means you choose your own investment strategy. You can see on the right-hand side of this screen lots of different investment companies, and typically they'll have funds available with different pension providers. You'll be able to choose multiple pension investments, and you'll be in charge of what level of risk you take and making any changes at any time. So if you're investment savvy, or if you want to look more into investments, again, your provider should have lots of information online or by getting in touch and finding out what do you want to do with your investments and actually what level of risk are you happy to take. Now, the final section of today's presentation is all about having a plan of action. Now, I'm not going to give you any homework today. These are things that we suggest you might want to think about, particularly when you're very close, probably about 6 months or so to retirement, or when you want to retire. Now, of course, if you want to retire as early as possible, that's great. But remember, it's great to have a plan and think about how much do I need in retirement? What do I want my lifestyle to look like? And make sure that you understand it is the right thing for you to do. If you're happy to work for as long as possible, of course, You may not worry too much about your pension because actually you may wish to work literally until the day you die. However, it's always best to save as much as possible should we need to stop working and of course want to continue our lifestyle. In terms of having a plan of action though, a few things that we might want to consider before retirement, particularly as I mentioned, 6 months before retirement. We have a few pages of suggested actions here. As I say, I'm not giving you any homework at all. These are suggestions. But you could, for example, check your pension statements. So remember, if you've got one pension, you should be able to keep track of that pension, hopefully fairly easily online or by receiving your annual benefit statement. If you have multiple pensions, again, make sure that you're registered to view all your pensions online, and indeed make sure you are still receiving your annual benefit statement from each provider. This will help you to understand what your overall pension is worth and what each individual pension looks like. Now, the Department of Work and Pensions in the UK will write to you 4 months before you're due to reach your state pension age. They'll then explain to you that you have to claim your state pension. It's not paid out to you automatically. Now, claiming is incredibly simple. It can be done in writing, over the telephone, or online. And as soon as you start to claim, that'll be paid to you regularly. Scottish Widows or any other provider that you have will write to you before you're due to reach your retirement age or your selected retirement age. That way we can start to discuss the pension options that are available and how you can access your money later down the line. At that point, you can start to talk about what your final pension will be and how that might be paid to you. And at any time, you can consider whether it's appropriate to combine your pension pots. So again, if you do have more than one pension policy currently open, you can combine or transfer them at any time. But remember, if you prefer to keep those separate, that is absolutely up to you. Remember, at any time to update your nomination of beneficiaries form to make sure it matches your circumstances. And if you've not completed that already, it is quite important. So please do think about that as soon as possible. As well as that, you might want to consider making or updating a will. Although that's not directly linked to your pension, it is something when we're thinking about retirement that maybe we should consider. If you're reaching or if you're at state pension age and you're still working, remember to make sure your employer is aware because you'll no longer need to pay national insurance contributions. As soon as you do retire or if you're thinking about retiring, let the taxman know at Her Majesty's Revenue and Customs because this might impact your tax code. Seek independent financial advice if you do want essentially pointed in the right direction of how you can manage your finances in retirement. But if you haven't done so already, as you're approaching retirement, it's really, really beneficial to get in touch with the government service PensionWise. Now, rather than going straight in to pay for independent financial advice, PensionWise are there to give you some low-level advice, but it's mostly impartial guidance to help understand as much as possible and essentially offer you some thoughts and some really good information on how you can manage and deal with your pension finances. One thing or a few things that we might want to consider is, for example, firstly, you can pay into a workplace pension or a personal pension by making a money transfer, what's known as a single contribution, so just making a random payment at any time. Or you could actually set up regular payments through standing order or direct debit. There's no limit on how many pension policies you're allowed to have open. And as I mentioned earlier on, you can normally retire at the age of 55 with a private or workplace pension. However, remember that age is moving to 57 years old in 2028. Now, one thought that we might not have considered yet is, do you know how many paydays there are until you retire? Well, fortunately or unfortunately, I might have an answer for you. So if you plan to retire at the age of 65, this might help you to understand how many monthly paydays there are until retirement. That's giving you an idea of how many opportunities there are to make an impact on your pension savings and really set yourself up as best as possible for the future and really have that lifestyle that you're hoping for in retirement. Now, before I finish today's session, a few useful links on this final page. A few I've mentioned already. For example, check your state pension, please do consider doing that so you can understand where your additional income might come from. I also mentioned PensionWise, the government-run pension service, so pensionwise.gov.uk, or give them a quick call. If you're looking to find financial advice at any point, remember that does always come with a charge for any advice, but you can find an independent qualified financial advisor at unbiased.co.uk or vouchedfor.co.uk. Finally, for anyone who has multiple pension policies and you may have lost track of one or two over the years, it's best that you try to find those so you're not missing out on any income in retirement. Again, the government can help with that using their pension tracing service. What they'll do is they'll talk to you about your work history, where you might have had a pension, and they'll help track down details to get in touch and find out more. That's gov.uk/find lost pension, or again, you can give them a quick call. For now, though, I'd just like to say thank you very much to everyone who's taken some time out to listen to this live, or indeed the recording later on. I hope it's been really worthwhile, and I hope there's been some good bits of information in there for you. For now, though, we've got a little bit of time that we can answer some questions. So what I'll do is I'll stop sharing my slide deck just now, and we'll go back on to the Q&A, and let's start answering through some questions here. So let's have a look here. So the first question we have is, and apologies, I should mention, I'll just take these from top to bottom. So if you have asked a question, I should get there eventually. But the first question I've got here is, if I die after the age of 75, does my beneficiary get the 25% tax-free allowance? That's a fantastic question. What I should mention is typically this money is not paid to your loved ones as a pension. It's paid just as income. So they wouldn't benefit from the 25% tax-free. If, however, you do die after the age of 75, your loved one isn't going to be paying, hopefully, huge amounts of tax. The money that they take will only be added to their income, and they'll only pay tax on the income that they take in any given year. The next question we have is, how does taking the tax-free amount in smaller sums work in practice? For example, how is the 25% calculated if the pot is constantly changing? That's a fantastic question. Essentially, if you take the 25% all at once, that 25% is calculated on a particular day, and you'll be given a lump sum. However, if you take the 25% in smaller portions, then you're absolutely right. The pot of money is constantly changing. So if you decided to take 5% portions, if you took 5% of a £100,000 pension right now, you'd get £5,000 tax-free. Later down the line, if you decided to take another 5%, your pension might have grown from the 95,000 it had left back up to 100,000, or indeed it's more likely to be somewhere in the region of 96 or 97,000. That means that the next 5% you take will not quite be as much as the first 5%, but it certainly will be more than if you'd taken the 25% all at once, because your pension is growing. So actually, if you take smaller portions throughout your retirement, you might actually take a lot more tax-free cash than you would have done if you'd taken that all at once. That's based, of course, on your pension growing. You are still allowed to pay money into your pension even when you are retired, but that's very limited, and most people, of course, don't have the additional income to do that. But if your pension is growing through investments, then of course that's going to help you take more money through tax-free than you would have done previously. Hopefully that answers your question. Excellent. The next question I've got here is, ignoring final salary pensions, is there any benefit in combining personal pensions held with multiple providers into a single managed pot? Now, that's a fantastic question as well. And as I mentioned earlier, it is an individual choice. However, there can be particular benefits. For example, if one managed pot has a lower annual management charge, again, just to explain, an annual management charge is essentially the only fee that you'll pay for any pension or investment provider. It's attached with every single pension, and some are higher than others. So if you moved some pensions that have a high annual management charge to combine that with a pension with a lower annual management charge, there is certainly a financial benefit to be had. As well as that, you might find it easier to manage in terms of having one provider and of course one pot to look at. What I should mention in that respect is, depending on what kind of pension product you have, your entire pension value may be protected. So if you did think that putting all your money in one place was perhaps not a good idea, because what happens if the pension provider goes out of business? Typically, these are all fully protected. So there are a few different benefits. You may enjoy, of course, the performance of a particular provider's investment. You may enjoy the investment choice that you have. But in particular, if there's a financial benefit or if it's just going to be easier, then that typically is your reason why you may wish to combine. Next question we have here is, I'm interested in the pros and cons of investing in pensions versus other forms of investments, such as index funds. Now, what I should mention actually in a very, very vague answer, I will go into a little bit more detail, but it's very, very much the same. Most pension investment products are actually index linked. What that typically means is that investments such as the FTSE 100 and those popular investments that you'll see indexed on the news and in the markets, typically pensions tend to follow those as well. As you can imagine, they're the investments that are the easiest to invest into and typically provide a good performance. However, that's not the only place that your pension is invested. It's invested globally in lots of different markets, depending on what you choose to invest into. If you invest individually into things like index funds, that will be separate from a pension, but it works in a very, very similar way. The difference is, typically you'll need to manage any individual investments yourself, make changes and try to make those, of course, at the right time, and make sure that you understand that you can, of course, lose out on money when you're investing as well as grow. It's a really great question, but typically most pensions tend to track those index funds. Excellent. Next question, I presume you take the 25% tax-free in drips and drabs as you might require it. You absolutely can, yes. So you are entitled to take 25% of your entire pension tax-free. You can take it anytime you like, in smaller portions or all at once. As long as you are early retirement age or older, you can access that at any time. You can take 1 or 2% here and there. You can take larger chunks, or indeed you can take the whole lot if you want it at once. Great. Next up, when looking for financial advice on investing or saving a tax-free lump sum, would a different financial advisor to the pension financial advisor be a better option? Now, that is a great question. You might have a financial advisor who specializes in pensions, but typically what you'll do is speak with an independent financial advisor. What they can do is they can talk about the whole of the market, including pensions, investments, and any other financial queries that you may have. So you may actually be able to speak to one person rather than going to different advisors. If, however, you speak to somebody who is a pension specialist, then absolutely it might be worth speaking to somebody else if you were planning on investing other money. However, if it is linked with a pension, then absolutely that pension advisor would be able to help. So rather than going to paying two separate people, it might be best just to stick with one. Excellent. Next question we have here, is it not good practice to check pensions annually? And also, can you use people about where they can get missing pension info? Excellent. Hopefully I've answered the second part of the question. If you are looking to find out about any missing pensions that you've lost track of, it's gov.uk/find lost pension. We also have a telephone number, but if you simply use a search engine online, Google for example, and type in find lost pensions, it'll take you straight to where you want to go. The first part of the question there, is it not good practice to check pensions annually? It absolutely is good practice to check pensions annually. It's even better practice to check pensions slightly more regularly. Now, if you have easy access to your pension, for example, using an online facility, you'll be able to check your pension every single day if you wanted to. However, I might not go as far as that. We're maybe used to checking our bank accounts online quite often, but our bank accounts change all the time, whether we're paying bills or using our card or cash to pay for things at shops. But your pension is slightly different. Because of the pension investments, each day the value of your pension can change. Sometimes you might go for a week or even a month where the value of your pension doesn't grow an awful lot, or it actually might decrease. That can make us feel like we're not invested in the right place, and it can make us feel down about our pension. However, if we were to check our pension once every month or every couple of months, over the longer term, we would see our pension hopefully increasing with those investments, and we wouldn't be too worried about the daily fluctuations that happen in the background. For example, if you have a pension that's worth £10,000 today, it might be worth £9,500 tomorrow. The day after, it might be worth £11,000, and the day after, it might be back down to £10,000 again. That's unfortunately how investments work, but over the longer term, historically, we've seen some great results. And of course, we can't guarantee any performance in the future, but checking your pension annually is a must, I would suggest. But checking your pension more regularly might help you to see how that grows and keep a track of how you're saving for the future. A really great question again. I'd be interested to learn more about annuity versus drawdown. Excellent. Again, hopefully I've answered part of that question, but just in a bit more detail. An annuity is a fixed product. Now, if you shop around for an annuity, what you'll find is that you can actually bespoke an annuity to yourself. So whether you have a product that starts out paying you a guaranteed amount that's slightly less each month, but then increases over time with inflation, whether you have a joint annuity with a partner, all these things can be built into an annuity. However, whatever money or whatever contract you agree on is guaranteed for life, no matter what your circumstances are. However, when we talk about pros and cons, I guess the con of an annuity is that you'll not be able to access any additional money at any time. You'll simply have to wait for that regular income. With a drawdown, you'll not have the guarantee that your money is going to last as long as you do. However, you will have the ability to take money at any time. So what some people do, and again, this is not a suggestion, it's not financial advice at all, it's just a potential option. What some people do is some people may take part, for example, 50% of their pension as an annuity, and some people might take the other 50% as a drawdown. That way, you're guaranteed some level of income every month or every year until the day you die. But when you want to or need to, you can access more money on the side from your drawdown product and manage your pension in that respect. You may wish to choose just one or the other. It's completely up to you how you spread or use that money going forward. But essentially, how do you want to access your money? How do you see your spending patterns being over retirement? Do you think you'll spend more money early in retirement because you might still be more active and want to do more hobbies and more traveling? Maybe spending a little bit less later down the line when you're less active. That might suggest a drawdown. Or would you be more happy to have the security of a guaranteed income every month? There's lots of different ways to think about it, but of course, either speaking with a financial advisor or getting guidance from things like PensionWise can really help. Excellent. Next question we have here is, I'm not earning much. How can I maximize pension contributions? What percentage of salary would you recommend? Fantastic question. And of course, at different times throughout our careers, we might have breaks, gaps. We might be working part-time, full-time, of course, different levels of pay, depending on what we do and where we work. But typically, when we talk about saving a percentage of your salary, no matter what your salary is, that will provide your lifestyle. And that means that a certain percentage of your lifestyle will be what you expect or what you need in retirement to get by. So if you're used to earning £1 million a year, you're going to need more money in retirement because you're used to spending so much. If you earn a lot less than that, then you're going to need less money in retirement. But because you're saving linked to your salary, it means we can recommend that everyone tries to save the same percentage. Now, we can recommend that people try to save 12% of their salary each month or each year. Now, that 12%, particularly with a workplace pension, is not just you. Your employer will also pay into a workplace pension, and you'll receive tax relief on the contributions that you make. Now, although we recommend 12%, you don't have to pay as much as that. It's about affordability. As long as you're making a contribution to your future savings, to your pension, you're making a huge impact on what your future looks like and what your pension looks like. Remember, we can get help from the state pension as well as any other sources of income that we might have. But really, our own pension savings is what's going to hold up our retirement lifestyle. So saving as much as you can is great, but it's all about what you can afford. The only thing I would suggest is that we recommend 12%. But a great question once again. Is the online government state pension forecast tool accurate? It is accurate. It's accurate based on your history of national insurance contributions, and it's accurate based on what you would be expected to do over the coming years. For example, are you likely to have at least 35 years of national insurance contributions? That's quite easy to answer. The things that are less easy to answer is what will state pension age be by the time you retire? So particularly if you're a little bit further away from retirement, state pension age might be even higher than we see it today. The other thing that's difficult to predict is how much your state pension is likely to be. So they can tell you, for example, you'll get a prorated amount of the state pension or the full amount. They won't be able to tell you in all guarantee what the full amount will be. For example, if you hit state pension age 5 years down the line, the state pension might be £200 per week. Currently, it's just under £180 per week. In 10 years' time, it might be 250. It's all about inflation. It's all about where the cost of living is in the UK. And of course, the state pension is there to help provide for us. So again, another really great question. There's some really great information to be found on that website. But of course, when it comes to projecting or predicting amounts, then that's where, of course, you've got to take that with a pinch of salt. Next question, can new beneficiaries be named on a workplace pension already being paid? Absolutely, you can change your beneficiaries at any time. Particularly with workplace pensions, just get in touch with your provider. Again, normally this can be done online if that's easier. All you'll do is fill out a new form, which typically takes a couple of minutes to do, and just add in the names that you want to be that you want to have your money paid to. So if you're making a complete change, or whether you're just adding or taking off a name, all you need to do is complete a new form. Let the provider know who you want to leave the money behind to, and of course what percentages if you are adding multiple people. Really great question. Next up, if you have a number of pension pots, say 4 50k pension pots, can you take the combined 25% from one pension pot, which may well be the total of 50k? Fantastic question. Technically speaking, you can take the full 25% from the overall balance, which is 200,000. However, that would need to be separated per pension. So you would essentially take 25% of each pension tax-free. You can't designate one single pension to be your tax-free portion, as of course these may be held with different providers, they may have different pension products, etc. You need to do that with each individual plan. So if you do have multiple pensions, it can of course be a bit more work to find your 25%. If you have all your pensions in one place, you'll still get the same amount, but you'll just be able to claim that all as one payment. Again, another great question. Excellent. Is it better to consult a specialist solicitor or a financial advisor about the best way to minimize death duties? Yes, is the very, very simple answer to that. It's a great question, but typically you can find out lots of information, again, using things like Money Advice Service, PensionWise, Money Helper, about what happens to your money and your possessions and your estate after death. Now, Maximising or minimising, sorry, death duties and making sure that what you leave behind is spread out so your loved ones don't have to pay too much inheritance tax or any if possible. A solicitor, probably more a financial advisor, certainly. An independent financial advisor would be able to help split up your money, tell you or point out where you could place your money or your possessions in order to leave your money behind in the best, cheapest possible way for your loved ones. So absolutely, you can find out a lot of information by doing research, but a financial advisor is best. Next question is, what's the benefit of having an AVC? So that's additional voluntary contribution via an employer versus setting up a personal pension if you can't put any more in an employer's pension. Okay, so if you're maximising your employer's pension in terms of the contributions that you're making, that's fantastic. Typically, you can make a one-off payment at any time, and it's very much the same as having your own personal pension. The difference is, if you have your own personal or private pension, you can use that money or invest that money in a different way to your workplace pension, should you wish to do that. But you have to remember that you'll be managing more than one plan. So it might take up more of your time in terms of pension management. If, however, you paid additional contributions into your workplace pension, you'll still get the same benefits in terms of the tax-free portion if you are within your allowances. However, it'll be invested and managed in exactly the same way as the rest of your workplace pension. So very, very similar. It depends on your personal choice of whether you'd like to manage them separately or whether you prefer to have that money in the same place. The next question we have is, how is defined benefit pension converted to transfer value? That is up to the pension provider. Now, your pension provider, what they'll typically do is they'll see that you have a final salary or defined benefit pension that suggests, let's say, it's going to pay you £10,000 per year for the rest of your life. What they'll think about in that respect is average life expectancy. They'll think about when you're retiring, of course, and what that might mean to you. And what they'll come up with is a potential transfer value. At that point, if you have a transfer value, you can speak with a financial advisor, and they'll have to do some research to make sure that that is financially of benefit to you. If it doesn't make financial sense and it's better to leave the pension as a final salary or defined benefit, then that will be the recommendation. If, however, it does make financial sense to transfer, then again, that might be the recommendation. But in either case, as long as the pension is worth more than £30,000, you'll need to speak to a financial advisor if you want to transfer. Excellent. Bit of a longer question I think we've got here. Thank you for the answer, but it's triggered a follow-up question. Okay. Am I right in thinking that if I take 5 lots of 5%, that's 25% I'm allowed tax-free, irrespective of when I take the sums and what the residual pot of money is worth? Or indeed, I could take 10, 10 and 5 whenever. So the 25% means 25%, not the 25% of the initial amount. Yes, I do understand the question, absolutely. Don't worry, I get this quite often. So yes, the initial amount when you take the first portion, so let's say you take 5 or 10 or just 1% of tax-free portion, your tax-free money, that's not the final value of what your next tax-free portion will be calculated on. It will be calculated next on the future value of your pension. So absolutely, it doesn't have to be calculated as a one-off. Again, another great question, and hopefully that answers that for you. The last one we've got here, I really do appreciate we're slightly over time, so apologies guys if I'm holding you on. Last one we've got here is, the Scottish Widows offer an advisory service helpline? We do have advisors available at Scottish Widows. Again, you'll need to pay for any financial advice. I probably shouldn't say this working for Scottish Widows, but I always do, and we're welcome to do so. But speaking with an independent financial advisor is usually better, because they can talk about the whole of the market rather than just one particular provider. Again, another really great question. Now, Lucy, apologies for running over time a little bit, but I'll pass back to you just now.
There is absolutely no need to apologise, Martyn. Can I just say, on behalf of everyone who's attended today, thank you very much for a very clear, very thorough presentation. Very interesting, and thank you for giving the time. And I hope everyone doesn't mind that we overran. We wanted to make sure that everyone's questions who had been asked got the answer. So thank you very much for that, Martyn. We will also be following up this presentation. Martyn's very kindly agreed that we will have a document with the questions of the answers. We will send that to you in an email if you've attended the event, so that you have the written answers down as well, just in case you've missed anything, because I know there was a lot of information there, all very useful. A huge thank you to you all for joining the event today. I hope you have found it useful. We are seeing a lot of people saying that they have, so that's great to hear. Do join us for the next event in the Discover series, which is in March, and this is about our Newcastle research, which is from bench to bedside, and it's looking at the journey of a cancer treatment, which sounds absolutely fascinating. So you can use the QR code there, or you can check out the website, the event website, where you can register for that event and other Discover events which we have coming up in the future. Thank you again for joining us today. Thank you, Martyn, for all of your advice and your answering the questions. It has been a fantastic event today. So I hope you've all enjoyed it, and I hope to see you at the next Discover event.